Welcome to NGEN Markets Training session. I hope my voice is audible to everyone. And meanwhile, people are still joining. We can wait for them. Until then, we can discuss about what are the topics to be discussed today. So basically, in this session, we are going to talk about fund selection of between different SEBI classification, and we are also going to talk about how do we use fund analytics from different SEBI classification and choose a particular fund which is appropriate for the clients. So basically our main purpose of fund selection in here will be the funds which are actually appropriate for the client's portfolio. So we are going to talk about this, and let's head down to our NGEN Markets terminal here. Let me just open my terminal. So I hope my screen is visible to everyone and I'm audible. If you cannot hear me and if I'm not audible, please write me on the chat. I will definitely make some amendments for the same. So let's go ahead. Let's see the screener here. So before doing our research, we would like to show you our screening section. In here, you can screen multiple categories altogether. And in this category, what you can do here is you can select multiple categories here. So, I'm just going to take into account one of the category as of now, let's say large cap. And you can screen the large cap as of, what I'm showing you. And here, yeah. And here, as you can see, once I've screened them, you can also filter the AMCs. So once I've filtered some AMCs, let's say I'm, taking into account only some few of the AMCs, I can remove them altogether from my filtration list, and I can, see the analysis altogether, like you can see here. And I can also filter the AUM here. So, to filter the AUM, all you have to do here is, let's say our minimum cap for AUM is 500 crores. So you can just type in 500 crores and apply it. So that's a fairly simple way to filter. We have also given some certain filtration columns as well. One of them is, you can click on this column and you can choose accordingly. Now, why this is important? Because this will save your time in filtering different sets of asset classes. Let's say we go for equity column. So for equity columns, we have selected equity funds here, and basically you can sort in according to any parameter. So what do I mean by sorting? Let's say you want to know what are the large cap funds which are having the highest mid cap exposure. That is, that is one use case. You can see these are the large cap funds, with the highest mid cap exposure. Or secondly, you can also choose in what are the best funds based on the Sharpe ratio or a Sortino ratio. So all you have to do here is you have to click on this, and based on the ascending and a descending order, you can see those funds accordingly populated into this particular screener. Now here, based on that, all you can do here is you can select them in a customizable way, so that you can make your sample space of your research smaller. This will be helpful for you in effective decision making as to which mutual fund is actually appropriate for the client. We are going to assess one client portfolio as well to show you how you can assess the portfolio and how you can choose the funds accordingly. Let's go ahead. You can select those large cap funds here. All you have to do here is click on this add to compare button, and that gives you ability to add those funds into the compare section. So now once you have added them into the compare section, you can directly onboard the compare section and see what are the funds which are actually loaded here. Similarly, I'm just going to show you how it is worked out. So I'm just going to load my composition here. To load the composition, all I have to do here is you have to click on this your saved comms, and I have actually preloaded the composition here. So I'm just loading for a large cap list given here, and I'm just going to select all columns to show you all the columns here. So once that is populated, you can see the entire large cap fund which is loaded here. So give us a moment, that will be loaded. Once this is done, all you have to do here is you can click on this and you can populate all the columns. Now these are all the columns which will be showing you all the funds accordingly. So I'm just going to show you this. Okay. So accordingly, here we have the fund list, and now this is, a large set of data which we have been shown from the large cap funds. Now how do we make effective decision making based on a client portfolio, or based on which large cap fund is actually one of the, appropriate fund for the clients? So we have given three sets of column. One is a return column, which is given in green. There are many parameters which shows you CAGR, standard deviation, and Sharpe ratio. Based on that, you can sort in and see which are the best Sharpe ratio funds in this particular list. Then we have also given relative column. Now, why relative column is so important? Because you can choose in one index based on, let's say we choose Nifty 50. Now we can actually see which funds are actually generating an excess return over benchmark on annual basis. So this is excess is actually an alpha. You can click on it and you can see that which are the highest, funds which are giving you the, highest alpha accordingly. So as you can see, these are the top, these are the top four, and these are the, bottom four funds based on the alpha which we have seen here. And we can also view the beta based on that, how the volatility is affecting based on the market. And you can also see the correlation. Now, why this is important? Because you might want to have such a fund which is not too correlated with the benchmark. So in that case, you can just see that which is actually having the lowest correlation based on the correlation analysis, what you have chosen as a relative index. So this is one, one category to look into when you are, choosing the fund. Next, let's say we have added some more sets of funds. Let's say we are, looking into some other categories as well. So let's say we are adding another category to show you another, set of analysis. I'm just adding another composition here. So by the way, this composition is very useful because whenever you, sorting and screening can be a bit time consuming. So we have given this function to, you can add those composition and subsequently analyze multiple categories of funds to see which are the best performing funds for the client in that particular SEBI classification. Now here, when you see that I have populated some mid cap funds, in this mid cap funds, as you can see, we have also given another column which is called as holdings column. Now holdings column is so important because you might want to recognize some funds which are actually purely mid cap, or which are having a very large cap exposure. So all you can do here is you can click on it and you can see these are the funds which are actually having the, highest large cap exposure. Now this matters because even if you think that, some of the funds are very performing, you might not want to give too truly large cap exposure to the client, or might be it is a vice versa. Maybe a client is holding highly into mid cap already. You might want to give such a fund which is having a considerable large cap exposure with a good mid cap exposure. So that's how this works out when you choose some funds. This is one, criteria we have given. Another thing is that when you go into rolling analysis, now this is one important thing here, is that when you look into rolling analysis, it gives you an overview. Give me a moment. I'm just gonna remove some of the, young funds to show you a better data point. So here, when you see the rolling analysis, in here, we have a start date and an end date. Now, what does this signifies here is that from this particular start to end date, what are the previous 260 days sum of the, data points. So basically, let's say we take into one consideration of one data point, HDFC mid cap. Now 40.15 just basically means that it is a previous sum of the 260 days returns, daily returns. Now if you, so for that you have to, already have to just, keep the methodology as simple returns for the sum of the previous 260 days daily return. And here you can recognize which fund is actually giving you the highest average from the start date of 2014 to 2022. Now, why this is important? Because what happens is, as an advisor or as a distributor, we always think about what is the, at what point shall I enter the fund and at what time shall I exit the fund. We are trying to guess the cycles of the mutual fund, and that is completely wrong, because there might be possibility that the fund might have not performed for 6 years, and then it performed after a 6 year period, it has given a huge performances, and it gives you a higher average. That can be a huge possibility. Now, how do you beat that? The only way to beat that is to stay invested for a longer period of time, so that you can recognize for a longer period that this is the fund which is going to give you that particular average, or this is the fund that's going to give you that particular volatility. What do I mean by this is, let's say we take into account 780. Now for 780 is actually a 3 years period, working period in a year. For a year it is 260, so that's multiplied by 3, gives you 3 years. So in that particular sense, you can see here that which particular fund is giving you a proper average. Now this also matters, because when you see Axis Midcap in this particular fund is actually having the highest average with the lowest volatility, and a considerably positive low. Now this particular fund might be one of the most appropriate fund for your client, but it might not be, because the client's need can only be assessed by the portfolio itself. So we are going to review that portfolio, and we are going to come back again into this analytics. But before that, I'm just going to show you how it works out in rolling analysis. The one thing for sure here is that you can look into the volatility of this particular rolling returns, and you can see what are the minimum volatility funds. Now why this matters? Because in this if you're going for a lump sum, it is if you want to take lesser considerable risk, you would rather go for such a fund which is giving you a higher average with a lower vol. And that also depends, because if you're going for SIP, then there is another scenario, because a volatility might affect the XIRR of any fund. So if you go for a higher vol, it is possibility that the XIRR of that particular fund will be higher in the SIP format. Let me show you how. If you go for a monthly SIP, and if you choose in some particular date, let's say 2018, and you run it, you can see PGIM India is actually having a highest XIRR. And when you come back into rolling analysis again, and when you see it, you can see that the highest volatile fund for that particular period was actually PGIM India. Now, this is very, very, important, so that you can understand what is the consistency of the fund for the previous 780 days period by using an absolute methodology and simple returns in the rolling analysis. And we have also given one more set of rolling return distribution, which helps you to understand what are the frequencies between the parameters. So let's say you have a return frequency. Your client might ask you which are the funds which are underlying between 40 to 70% for the period of 780 days, which is 3 years period. So for that, all you have to do is type in that, and you can see the frequencies accordingly. So accordingly, once I click enter, the frequency is shown it up to you. So you can see that this some of the funds are actually having a very higher frequency, such as Franklin India, or you can see Axis Midcap. So these are the funds which are having highest frequency. Even you can see DSP Midcap is having a highest frequency. So this helps you in taking decisions as to which fund is actually appropriate for your clients. Now the second thing here is, we should also look into risk versus return tab. So I'm not gonna discuss the entire comparative analysis here. I'm gonna discuss some intricate details here, like risk versus return, monthly SIP, and some positional overlapping, as to see which funds are actually good for the client. One thing for sure here is, you can see based on the point-to-point analysis, you can choose in some dates, you can click go, and accordingly you can see that which particular fund is giving you appropriate returns based on that standard deviation, which is a risk. So you can actually go for such a fund if a client is conservative. If you're making a conservative portfolio and you want to add in some mid cap funds, you would rather not go for such a fund which are highly risky. And this is very important, because when you go ahead with a highly risky fund, it will display in the analytics that this particular portfolio is underlie to more risk. So that's how Uh, uh, yeah, so there is another question that can't we select date before 2014? Why? Because we have taken minimum common period. So a minimum common period in the sense is that whenever you take a fund into account in the fund list, the youngest funds, start date will be chosen. So here it is Motilal Oswal mid cap funds. That is the only reason when you go into risk versus return, you cannot choose before 2014. If you remove the youngest fund, you will definitely see that the dates has been changed. If I remove Motilal Oswal and PGIM, you will see that it will become 11 years. So it's just an example. That's how this works out, and you can see accordingly that it will change accordingly. So that's risk versus return. And let me show you, it has become 2011. So let's go ahead with another thing, which is actually positional overlap. Now, why this is important? Because whenever you're trying to suggest such a fund for your client, you would like to suggest a fund which is having a low positional overlap with other mid cap funds. There is a possibility the client is holding 3 to 4 mid cap funds, and you want to suggest a fund which is also a mid cap, but you want to remove all those, and you can see that which are the funds which are giving you a low correlation, low positional overlap. So in this sense, you can click on them and you can definitely see the overlap between them. So you can see the 41% overlap between Nippon India and ICICI Prudential mid cap fund. So this is how the comparative analysis works out, and this is how you can actually see how the funds are performing based on the parameters of positional overlap, correlations. And all you can do here is you can also add in an index. So if you want to individually analyze multiple mutual fund, it is fairly simple to add in an index to compare the mutual fund with that particular index. So all you have to do here is you have to select on the select index, and then you can you can see that the index is actually populated here, and then you can click on performance chart. So after clicking on performance chart, you can see these are the these are the funds, and there is an index which has been added here, which is Nifty mid cap 100. Now this is quite cluttered, so there is another way to show you how do you compare index. What you can do is you can click on those and remove them accordingly from this particular graph. What do I mean by this is, if I click on Nippon India Access, and if I click on such funds, you can see that accordingly they are removed from the graph. And this is a dynamic analytics which helps you in comparing 2 to 3 funds with the index. So you can see that SBI Magnum mid cap is actually light blue, and is actually dark blue, and ICICI is light blue, and there we have our index. Accordingly, you can add more index to compare it accordingly for the point to point dates. Let's say we go for a last 3 years period. So for the last 3 years period, what is our performance? What is the performance of these two funds based on other funds? So you can choose in those 2 or 3 funds. You can keep your index and start analyzing it. And here we have also given another based on a hack, which is you just have to zoom in. So to zoom in, you can just zoom in based on that particular period, and you can zoom in that particular period accordingly. That's how this works out in performance chart. And then you can do the point to point analysis. Now why this is important? Because you might want to know that which are the funds which are currently performing better, but they haven't been performing from the last 10 years. So all you can do here is you can choose those particular scenarios here. Let's say you want to know how that particular fund has performed in 2019 when there was a election period, or let's say you want to know how it has performed in 2018. So you can definitely see some scenario making. You can choose any such calendar years, but calendar dates here, and accordingly you can see the cycles of those particular mutual fund. Now here we have also given one more thing, which is years section. Now year section is a calendar year section which helps you to perform analysis based on the calendar years, and you can see accordingly that how the performance has been in those calendar years. And not just the funds, you can also see for an index. So this is very important, because let's say you want to know how the index has been based on in 2020. So we have a scenario in 2020, COVID scenario, and we are trying to compare the mid cap funds with our peers, and where the index is standing up and where we are. So if you're choosing a fund which is like Aditya Birla SL mid cap, so are we making a good sense out of this? Because we have not outperformed in this particular period. You can also do it for other use cases for 2021, 2019 to actually backtest and to actually signify that the factual data which is shown up to you and the decision you have made for your client, is it true to the, the factual data here? So that's how this works out. Now for here, there are two things. One thing is you can load fund analytics. To load fund analytics, there are two ways. One way is to search the fund from here. Another way is actually to, onload the fund by clicking on it. So if I click on any such fund here, let's say this first fund, there is a new tab which will open up, and then you can analyze that particular mutual fund. You can also onload more funds. I'm just going to add in another one, let's say DSP mid cap, and accordingly you can, subsequently analyze parallelly with two tabs for this particular funds. Now here, when we look into this particular fund, we have further sets of analysis. Let's say you have taken a decision that the, most conservative fund with the lowest volatility is this particular fund from rolling analysis, and let's say you're going for such a fund for your clients. So you should, look into the analytics and see how much risky is this fund, what are the risks, what are the underlying returns for this particular fund, and is it beating the benchmark or not based on the start date we have chosen. So for that, you can just load in a fund performance and you can see accordingly the cumulative returns, CAGR, and you can also, look into value at risk parameter. We already had a session called, value at risk before. If you may, you can check it on our YouTube channel. We have also given the link there. For value at risk, I'm just gonna give you an overview that, there is a 5% probability that this particular fund will give you a drawdown of negative 22.94%. You can change this confidence interval. You can keep it as 99%. And accordingly, you can see for the worst case scenario, this fund could give you negative 40.40. Similarly, you can do it for a DSP midcap as well. Now, why this is important? Because this actually looks into the downside risk. Now for DSP midcap, it is negative 45. So as you can clearly see that Axis midcap is actually lesser riskier than DSP midcap just by parallelly analyzing the value at risk parameter. So historical value at risk is based on the historical returns, and implied is based on the volatility. So you can also choose in, 99 for based on volatility implied value at risk, and you can see the, negative drawdown accordingly. Now for that, for relative column, definitely you need to have the same benchmark to compare the two funds. One thing for sure here is that we have given excess return over benchmark, and we have given up capture ratio and down capture ratio. uh, Many of times, if you want to see what are the, underlying up capture months, when the benchmark was up, how the our asset has performed. So you can see accordingly that we have actually not performed based on the up capture. So significant annual return over benchmark has possibly came from the down capture. As you can see, we have given lesser risk than the benchmark. So this gives us, a lot of, scenario making as to, how this particular fund is actually behaving against the benchmark. And here we have given certain columns of monthly chart and yearly chart. One single thing I would like to signify here is that this chart is, fairly overlooked by all the advisors. I would suggest you to all check into this, because this gives you the monthly details as to how many months it has been up and how many months it has been down. Similarly, it also shows you that, there are, from this 10 years, this particular fund has only, had a negative return in particular year for one time in 2016, as you can see, which is negative 3.11. As to other years, it has always given a positive return for the 9 point, so 90% of the time, it has given the positive returns from this last 10 years. And that is actually a, a good data to actually convey to the client when you convey it. So this is how this works out based on the performances. There are certain more things to look into for, based on any particular fund is an asset allocation, because this also makes a sense to see that, how the asset is allocated. You can click on a certain detail view and you can see what are the, intricate asset allocation for this particular fund. You can see the, you can click on derivatives, you can click on net CA, you can click on reverse repo, and accordingly you can see the positional changes by month for this particular fund. Now this analytics shows you based on every single month what are the positions added and what are the positions removed for every single month. You can click on 31st October, you can see these are the positions added, and based on over time you can see how the positions has been changing accordingly. So you can uh, see by sector and by security, and you can actually see here within the percentage format which we have given here. So this is how you can choose the fund, and you can create a PDF report for the client. You can see the concentrations here, as you can see it is having a very high large cap exposure, and the top three securities of this fund is actually having 19% of asset allocation. What are those top three securities? You go into the overview, you click on show all, and you can see that CCI, which is cash, you can see it is 11%, 10.52, and then this two is Cholamandalam and ICICI Bank. So accordingly, you can see the asset allocation of the particular fund, any fund which you load in, and then you can see the equity sectors which we have given here. You can click on every single sector and see the stocks. Now why this is so much important when you look into this fund, and why whenever you choose in a benchmark, you always compare it to the benchmark. But there is another comparative analysis which is very useful when you're trying to select a best fund. Best fund in the sense is an appropriate fund. So all you have to do here is you click on peers, and here you can do a peer analysis. So for peer analysis, we have given a SEBI classification average, which helps you to understand that are we above average based on that particular parameter, or are we below. In terms of volatility, definitely we would like to be below average, as you can see, which is 14.70. And in terms of Sharpe ratio, we would like to be higher than average, so so that we can generate higher returns based on the risk. So that's how you can compare it with the SEBI class average, but also you can individually compare with other funds. So let's say I want to know what are the highest Sharpe ratio funds here. So these are the highest Sharpe ratio funds in the mid cap category, all together in SEBI classification. Now this peer analysis, which will also help you in looking into TER percentage, expense ratio. So all you have to do here is you have to just click on this, and you can compare the expense ratio of the fund you have chosen, against the others in the mid cap funds. So this is how you can look into, and this is how this works out when you want to do the peer analysis. We have also given an Excel which helps you to download the entire peer list, and you can generally do Excel analysis on the peers. Here we have given some parameters where you can compare based on 5 years, 3 years, and 2 years as well. Now this is all about fund analytics. Now what I'm going to talk about is that how do we select an appropriate fund based on the analysis we made into the compare section, and based on the a fund analytics we have given. So let's load in one of the portfolio from the client section. I have actually made a portfolio to show you all, to save time actually. So I have made one portfolio here. Now in this previous session we had how do we assess a portfolio, how do we actually look into some asset allocation, contribution analysis, and correlation. In this session we are just gonna see that some of the intricate details, and we are gonna fill in those gaps. So what are the gaps when we look into the types of the funds of this particular portfolio? You can see it is highly into mid cap, 42.81%. And even if you look into the fund list, you can recognize from here that there are actually 3 to 4 mid cap funds into this particular portfolio. You would there might be some client who you have approached to, and you can use such strategies to recognize what are the loopholes in the portfolio, so that you can explore them and you can fill those gaps to convey your client that these are the loopholes, and this is how I can help you to get your portfolio better. Similarly, we have actually analyzed some of the mid cap funds, so we have definitely understood that there are some funds which has to be removed. One of them is Sundaram mid cap, which was actually underperforming. Other is Aditya Birla. So you can, remove some of the, mid cap funds, and then you can add in a fund which you have chosen into the compare list. So let's say we go for let's say our client is fairly into mid cap but wants to go into large cap as well. So all we can do is we can add that, that fund which is also having a good large cap exposure and a mid cap exposure as well. So what I'm doing here is I'm just adding and filling those gaps. So let's say I keep as 30% as an example, and I just I can add another fund. So as you can see, the allocation is still 87.19. I can add some blue chip fund. So let's say we add in okay. So let's say we add in this fund as of example, and we just rescale it to 100. Now here, accordingly, we can run it or we can update it. If we run it, it will not affect the previous portfolio which we had made changes in. And if we just update it, then it will update and override the entire portfolio. I'm running it right now to show you that how the analytics is working out. And in here, then once you look into the asset allocation, it will show you that how how the asset allocation has been changed based on the fund we have changed accordingly. So you can see now the mid cap exposure is fairly lesser, and we have mid cap funds exposure. And if we want to see the entire concentration, now the mid cap is fairly lower than before, and we have more large cap exposure now. So now you can tell your client that this is how you have made the changes in. You can save this portfolio and make a comparisons of the two portfolio to show that the changes you have made. So you can just click on one of the portfolios of theirs, and you can click on the right which you have changed, and then do the comparative analysis based on the changes you have made and how superior changes you have made for your client. This helps in not even just for existing client. This helps in a new client as well when you want to acquire it. So if I just add in some some of my comparative portfolios, you can see that there is a annual return difference of 2.82%. So what you have done is you have checked into the asset allocation. You can not just asset allocation. When you look into some clients, let's say this Vedantan, you can definitely find some loopholes where do you want to concentrate your entire exposure to. So this portfolio will actually tell you that where should you search for fund, which fund is actually appropriate for me, because the performances and the the value at risk parameters will give you the return and risk parameters accordingly. And then you can see which are the funds which are not contributing. Based on those, you can actually reduce those exposures, non-contributing exposures, and increase those exposures which are giving a good contribution, and add them to your own asset allocation. So this is how the entire thing works out when you want to have funds which are fairly appropriate for the clients. And every time I would normally suggest this, that do not look into the cycles of the fund. The fund will have an up cycle and will also have a down cycle. The key here is whenever you look for a long term, you look for the fund which is actually consistent based on the rolling returns, based on the risk versus return parameter. And also you look for the positional overlap, as to if I load in some funds, I would rather want to have funds which are having a low positional overlap, so that my market risk is minimized, and I would have a diversified approach in my portfolio. So if I look into my positional overlap for this particular portfolio, you can see that Axis Blue Chip and Franklin India Blue Chip is actually having a very high positional overlap. And you can understand this, that both are similar, yeah, both are also from similar category. So it doesn't makes any sense to keep Franklin India fund in my portfolio. And that's how you can recognize these loopholes, and ping in some good funds for your client, so so that the client is satisfied with your approach and with the approach you have made. Now one thing for sure is some of the advisors might have an approach that the current performing will perform better in future. Some might have a contrary approach, that some which are not performing right now might perform better in future. So whatever you have chosen, we have given the tool to see what are the purest funds in those particular categories, in those particular capitalization. And you can actually recognize that some of the funds, if they are not performing, they are maybe sticking to their own ideology. As an example, I'm just giving you one single example: Motilal Oswal. Motilal Oswal mid cap actually has the highest, one of the highest mid cap exposure, and it sticks to his own category as a mid cap fund. So because of sticking to the category, they might have sometime a lower underperformance against the benchmark. So that particular thing is all subjective, that which fund is actually the best fund. You can use these all tools to come up with winning funds, a winning portfolio, and solve all the portfolio challenges what the client is actually facing. So this is all for the entire session. We can start with the Q&A with everyone. You can either write it on chat, or I can answer them verbally as well.
Hi, that was a wonderful session. I have two questions, if I may ask it.
Yes, sir. Please ask.
Okay, one is with respect to the index against which we are trying to benchmark. Most of the indexes which we see here are, say, normal indexes, not TRIs. Is there any plan in order to bring in TRI so that we can compare it against the total return indexes?
Sir, we actually, had one of the query raised in one of the webinar, and actually this is being in development, because we are constantly in talk with our data provider regarding having more TRI indices. So once we get some good feedback from them, we will definitely update to all the community here. So we are actually planning for this, because the more the indices is, the better is for you to compare it between the funds.
Okay, I have a second question now. Now coming to the portfolios, you see the performance section in the portfolio?
Yes.
Yeah. In there, the CAGR since 2nd November 2009.
Right.
Sometimes what I have noticed is some of the funds which would have started somewhere around 2015.
Right.
We might have included that particular fund also while we are constructing the portfolio.
Right.
At that point of time, how does the CAGR gets calculated? Because this would be non-existent for the first 6 years in this
Got it.
calculation.
Got it, sir. Got it. So, what we do here is we normally suggest you take into account minimum common period, because this gives you a fairly enough idea, because, one of the youngest fund might have been started in 2018.
Yeah.
But, we had this system before, that we used to, just keep it as 2018, kept it as a minimum common period. But due to some responses by other advisors, that we want to have, you can choose in a start date which is more than, so you can have it since inception. So it takes into account only those funds which are there from the inception, or which are starting from that particular start date. And if you want the calculations, we can actually have a training session with you, and we will give you all the calculations and also.
Yeah, I think that would be really good.
Yes.
I will connect with my RM for that one.
Definitely, sir. You can connect with us. We will give you all those, feedbacks.
Thanks a lot for clarifying these doubts of mine. Thank you.
Thank you, sir. Is there any other questions?
Hello.
Yes, ma'am.
Yeah. How can we import the portfolio of our existing clients?
Okay, so you want to import the portfolio of your existing clients?
Yes.
Ma'am, we have given two ways. One of the way is that RT connection is given here. So if your RT connection is actually not done by our side, so please let us know, because in RT connection your ARN can be onboarded, And here your all the existing clients will be onboarded via CAMS and Kavi. So you can click on any of your existing client and you can run the analytics on them. This is one way. This is an automated way. Another way is a manual, a way where you have to actually onboard a CDSL or an SDL CAS PDFs. All you have to do here is you have to come into the portfolio section here. Let me just show you. Give me a moment. And you can add in a portfolio from here. And here we have given some upload options, which is CDSL CAS PDF, which looks something like this. So these are all summary reports. We only accept summary reports. And here you can add in file password and your portfolio can be onboarded. Any portfolio.
This we need to do one by one for all our clients.
Yes, so this is the model portfolio section. But for your existing client, please let us know from the RTA team. Our RTA team will contact you, and your all the clients in your ARN can be onboarded.
We are running 2 ARNs right now.
Okay, so our technical team will contact you based on this, and we will get it forward with you. So we have
initially we will start with the one ARN, but on the RTA side we are trying to incorporate multiple ARN so that you will not have to depend on your existing back office at all.
Actually, what is the problem? Like in all our clients. Hello.
Yeah, yes, please carry on, madam.
Yeah, for all our clients, we are recommending the schemes and investing through both of our ARNs.
That won't be a problem. Initially, what we have done is that when we are doing this auto RTA forwards, we have only considered one ARN, but now we are opening up our multiple ARN facilities. It will take some time, but once that is on, then probably you will not have to depend on any of your back offices.
And how much time will that take, sir?
Maybe a month or 2.
Okay, because in that scenario, we won't be able to, see the complete portfolio of any of our clients.
So you can start with one ARN and then just have to hang on with us until I've given you the maximum time. It can come before that also.
Okay.
So, but at least you start with the one ARN and you can start using the client section extensively.
Okay.
Okay, there is another set of question here. What is position list? So it is by Mr. Parasha. Okay, so the position list is you can just print this position list. So it just means that whatever positions you have taken in the mutual fund, the entire position list is is actually added into this one particular PDF, and this you can share it with your clients. So this is just a portfolio position list, and you can do it for even an equity portfolio in the portfolio section, where you can run analytics on any such portfolio and print the position list for the same. There's another question. What are the parameters incorporated in regards to correlation while we are comparing two funds? Okay, so for this, the parameter is actually based on the historical return. What it does is it actually compares the behavior of the daily historical data of these two funds. Let's say we go for L&T infrastructure fund and L&T mid cap fund. So now based on that, you can see this is a matrix and this is the ratio which is generated, which is 0.91. Now the more closer it is to 1, the higher the correlation is, and the lesser closer it is to 1 or lesser closer it is to 0, it is lower correlation. In this case, you can see some of the funds are actually having a very low correlation, like L&T Infra and ICICI Prudential Pharma. Why? Because the behavior of their of their NAVs, basically price series, is actually fairly different. So that's the reason they are having a different return, daily return series, and that's the reason they are having a different correlation ratio given here. And we have given. we have given, yeah, so we have given here, all the, you can compare it even here and even in the funds compare list correlation. So you can compare it any point of the time for any such period. There's another question: isn't correlation also related to the type of the securities involved between two asset classes or funds? So essentially, for correlation doesn't takes into account any asset class or any type of the securities. Let me tell you why. Because mathematically, if the types of securities are different, as in the sense this floating interest fund, it will definitely have a different correlation with an equity fund such as Nippon India Pharma. So that's the reason the correlation will show you a lesser correlation, because their price behavior is completely different than the equity counterpart. That's the,
The system goes like this. If the funds or the scheme is same, the correlation will always be one. And more it is different, it will tend to go away from one. So that is the system. So how much of a different asset class you bring in, your correlation will deviate from one. If it is similar to the asset class that you are comparing, it will be closer to one. So that is the way correlation is calculated. Any more questions, Umar?
sir, there are no questions. Is there any other
Then
questions from everyone?
can we wind up now, please?
Yes. So if there are no questions, thank you for attending this session. It was nice having you on board. So in the next week we are also gonna have another sets of new topics. And if you have any questions later now, so you can ask in the next session, and we will definitely answer them all. So thank you so much, and thank you so much for attending this session, and have a nice day.
Thank you so much.